In this video, we're going to introduce the current account and the capital account. And so the current account measures the flow of sort of dollars and goods and services across borders. And so it's going to be the trade, so the trade deficit, trade surplus, we got exports and imports. It's going to be net income that we receive from other countries and that we pay to other countries. And basically you can think of it, all right, well, at the end, if we have a balance, that means that we sort of, the amount of dollars that went overseas was the same as the amount of dollars that came back. If we have a deficit, that means that there's more dollars overseas at the end of the year. What are those dollars going to do? Well, they're going to buy U.S. assets, right? And so that's not a trade, but it's a change of ownership. And those assets could be financial assets like stocks and bonds, but they could also be real assets, right? Like buildings. And so what we need to think about is sort of the balance between the current account and the capital account. So how those flows end up sort of balancing out in the capital account. So foreign exchange is just the buying and selling of foreign currency. As I mentioned in the previous videos, the foreign exchange market is huge. If you want to lose your money very quickly, you should invest in the foreign exchange market. The balance of payments is the account. So that's the current account and the capital account that sort of summarizes the country's transactions with the rest of the world. So now, so far, we've been mostly talking about exports and imports of goods and services, right? That's the trade balance. But it's not the only flow of transactions that happens with the rest of the world. There's also a net income balance. And so, for example, if someone who's not a United States citizen owns stocks or bonds and they receive dividends or interest payments, those are going to be income flows that go out of the country. And similarly, if a U.S. citizen owns stocks or bonds in another country and they get dividends or interest payments, those are going to be flows into the United States. And it doesn't just have to be financial transactions, right? It could be like, okay, I own a company in France and I get profit and that profit comes back to me. And so that's a flow from France into the United States. And so there's going to be a lot of those flows. And what we're interested there in is the balance, at least in terms of the current account. So the current account balance, that's just the net, right? So if we have a current account surplus, that means we have positive net payments from the rest of the world. That means we sort of have more foreign currency than we started with. If we have a current account deficit, then it means the rest of the world has more dollars than they started with, right? And so the U.S., because of the trade deficit, tends to have a current account deficit. And so we'll talk about what that means. But that means we're sort of buying more imports than we're exporting. Well, we're paying for those imports with dollars. We're getting foreign currency from our exports. That means there's extra dollars out there in the world. Those dollars have to go somewhere, right? Because you can't use dollars to buy stuff in Brazil or France or China. And so that is the capital account. And so the capital account, or we call the current account sometimes above the line and the capital account below the line in our balance of payments, is the change in foreign holdings of domestic assets and, frankly, domestic holding of foreign assets. So the net capital flows, or the capital account balance, is can be an increase in net foreign indebtedness, meaning holdings of domestic assets minus the increase in domestic holdings of foreign assets. What does that mean? Well, it means that, the change in, did the U.S. end up owning more foreign assets than foreigners owned of U.S. assets, or opposite? So a capital account surplus means that there were positive net capital flows into the country. So that means an increase of foreign ownership in the country. And a capital account deficit means there were negative net capital flows. So that means we increased our ownership of foreign assets more than foreigners increased ownership of U.S. assets. And then, so the capital account and the current account should balance, right? Because all those dollars that were overseas from our current account deficit should come in and buy U.S. assets. That doesn't always happen. And we don't always measure everything correctly. So there is a statistical discrepancy, which can be fairly large, and as we'll see in the next slide. So this is a sort of simplified view of the U.S. balance of payments from 2014. So in billions of dollars. So, $2,343 billion of exports is $2.3 trillion of exports, right? So that's a lot of exports. But we imported even more. So we imported $2.8 trillion of imports. And so our trade balance or deficit was $508 billion in 2014. So that's the first part of the current account. Now, from income received, so this is the income that Americans received from countries around the world, was $823 billion, and we paid $585 billion to foreign individuals, corporations, whatever, around the world. So our net income was just 823 minus 585, or 238. So we had a positive net income. Net transfers received was negative. So transfers is like when someone just sends money to another country. So for example, the United States probably basically always has negative net transfers because we have a large immigrant population. Those immigrants are earning money. They're taking some of their money and sending it back home to family that are still in their country of origin. So that was minus 119 billion. And so the current account balance is just the sum of 1, 2, and 3. So our trade balance plus net income plus net transfers received ends up being minus $389 billion in 2014. So that's the current account. That's above the line. What about the capital account? Well, the increase in foreign holdings of U.S. assets was about $1 trillion, so $1.031 trillion. And the increase in U.S. holdings of foreign assets were $792 billion. And so that gave us a capital account balance, which is just, the first line minus the second line of $239 billion. Now, theoretically, this should match up with this 389 billion, right? It should be a positive 389, but it's not. And so our statistical discrepancy is 150. And a statistical discrepancy is just that. It's like, well, we measured something wrong or something else is going on. So keep that in mind, right? That there's $150 billion that we didn't quite measure correctly or something else is going on. So one of the things that's important to think about is the difference between GDP and GNP. So if you took economics, 30 or 40 years ago, well, maybe more 40 or 50 years ago, you would have talked about GNP, which is gross national product. And gross national product measures value added by domestic factors of production, meaning like all citizens and corporations of the United States around the world. Whereas GDP measures value added within the borders. And so GNP is just GDP plus net income, right? So our net income we saw from here was 238. So we had positive net income, so our GNP was a bit higher than our GDP. That's not always the case, right? In a country like Ireland, their GDP, because they have a lot of foreign companies that are headquartered in Ireland, their GDP tends to be higher than their GNP, and so they have a negative net income. For some countries, it's significant. For other countries, there's not a huge difference, right? That's not a huge difference for the United States on a, I don't know what GDP was in 2014, but it was probably something like 16 or 17 trillion dollars. But for other countries, it can be significant, right? It's significant for Ireland, and the example that they give in the book is Kuwait, where it was significant in Kuwait. And so they ran a large current account surplus. They were exporting, obviously, a lot of oil, importing less, and accumulated a lot of foreign assets, which meant that because they have these foreign assets, they're getting a lot of net income from those foreign assets coming into the country, so that GNP was significantly higher than GDP. And so you can see that, net income was a significant source of their income over these years. So, for a small country like Kuwait, it's not surprising that there can be a big difference. For a large country like the United States, we wouldn't expect as big a difference.